To be a manager, I'm gonna do the same thing.
So we're gonna do a little practice of what we. I mean, I just love the conversation. My heart just broke that I had to stop it. But we're going to kind of do a couple little practice questions, and we can certainly work through this as a group if we want, and kind of talk it out, or if you want to work through it individually, that's fine as well. But the first question that I kind of want to go over is, what is the present value of a cash flow stream if the opportunity cost rate is 10%? So walk me through how you would set this up, or better yet, you're going to be the scribe,
You know what my
and I'm going to
handwriting
sit
looks
in the
like,
back, and I'm going to hear how you guys walk each other through solving this.
So that means you all have to solve it and I'll write it.
So how do you first set
It's
it
all of us, so if we're going wrong, then you have
That's
to.
unethical.
Alright, what is the
So we're looking for the present value, right?
2,000.
Oh, yeah.
We have uneven cash flows.
What is the present value of the cash flow stream? Is 10%,
If the
so it's
opportunity
2,000
cost
times
is
10%,
10%, yeah. So,
right?
2,000.
Times 10%.
Now think about what we just learned about
Is it the
uneven
one-
cash flows.
it's gonna be different,
Mhm.
I mean,
So set up our
Based on the
timeline
years.
still.
okay.
Okay, so
Mm-hmm.
then it's 2,000 here. I don't remember. Need my notes.
You can get your notes if you need. This is not close notes or close book. Open book collaboration. And I'm going to go ahead and pause the video for our online students, and we'll pick it back up when we get to the answer. So we're going to go forward through to the answer. So we set it up just like we normally would on a timeline, right?
Oh, so this is one.
Right. So 2,000.
And
2,000.
then 2,000 for the one.
Right. 0, 1,500 throughout our periods.
So what is the question asking us though?
What is the present value
Of the cash?
of all of the cash when we discount it back
Okay.
at year 0? So we have the uneven
The
cash
present
flows.
value.
Yeah.
Okay.
So instead of compounding it forward through to year 5, we're discounting it back to year to the initial year 0. And this is our present value of our uneven cash flows at year 0.
Alright, so and it's the same, it would be the 2,000
Mhm.
times the 1 plus the 0.10.
Mhm.
Okay.
Yep, just like
Okay,
we
so
normally
it's-
would.
Okay.
Yeah, remember I said burn that formula? Is it
Yeah,
right?
I mean, it's there, I was
Yeah.
just sure. Cause I
Like I
mean,
said,
I guess what, I wouldn't set up the timeline, I think that's what it is.
Oh,
I would've
yeah. Just done the formula.
formulas.
Yeah, and that's fine too. I just use the timeline to stay consistent with kind of what the book presents, but I would do that too. Just set up the equations.
Wait, what's the question?
It's present value instead of, the time,
At year
What?
0,
present value. Future.
9,000.
Oh, this one?
Yeah. So we know the
So it's gonna be the 2,000.
future value divided
Division
by
is what?
1 plus I.
Division of
What
what?
is this? Future value?
No,
No.
we're doing present value,
Present value.
Yeah.
Right. future value
And then the division.
divided by 1 plus I
Okay, the division.
to the period.
The present value at year 0.
Is going to be 2,000. And you don't have to even do the calculation because we're at year 0, right?
Mhm.
So this is going to be 2,000. Then we start our calculation at end of year 1. And we're gonna divide that back by one period, right? 'Cause we're
Yeah.
discounting backwards. 1, 2, 3, 4, 5. Take all those numbers, add them together, and this is the value of our uneven cash flow at year 0.
Okay, so it's already done.
Yeah. Yeah, this is the answer.
Yeah,
this is
that's
the
what
answer.
I'm trying to
figure something out.
Yeah, this is the answer.
sorry,
Yeah. So discounted back, this is how it would look on your timeline. If you choose to use that method, or you may want to just do the calculations out, and that's fine too. Like I said, I just stick with the timeline to stay consistent with what the book says, but however gets you to the answer, by all means. This may be confusing for some people, and that's fine.
It's not just.
It just seems a little longer. Yeah. I'm all about simplicity. Okay, so what about future value of the uneven cash flow stream? If we invest in an account that pays 10% annually. So we were just looking at present value, right? Trying to find present value. Now we're trying to find future value.
For each one.
So it's gonna look similar to this, but all our amounts are gonna be on this side, right? And we're gonna add together. And in the interest of time, and you guys can certainly work this through your book, and if you want me to check your answers, perfectly fine. Just put in the.
For the future is multiplication.
Okay. Okay.
So you divide what it's past and you multiply what it's for the future.
Right.
Future.
So when we're looking for the future, we're multiplying, searching for past, we're dividing. Okay. So future value at year 5 is gonna look, set your timeline up the same way, same formulas. The only difference is before we were looking at lump sums, and now we're looking at uneven cash flow. So you multiply everything out the same way, and you should get to 14,714. And if you want to work these examples in the book, I don't have this particular slide deck up on D2L, but if you want to work these in the book and kind of check your answers, just let me know. And you can send me whatever you got, and I'll check it and say, yeah, you were right, or you're off here in your calculation. Okay, so I think this one is amortization schedule. This is one I kind of wanted you guys to practice on how to set it up. So we have this healthcare system that's borrowed $1 million on a 5-year. So let me erase this over here. So we have 5 years, or we have $1 million, right? 5 years. On a loan at 15% interest rate. First payment is due a year from now, and it's calculated to be, so we've already passed step 1, right? Or step 1, right? We know our payment is going to be 298, 315, 55. So how would we set up the amortization schedule knowing all this information?
Is it that table, the period on?
Right, the table.
So the period would be first, I guess.
Beginning balance.
Wouldn't it be the period, the amount of years?
Yeah.
First,
Yeah, period.
and then the. Yeah,
Yeah.
1 to 5, 1 to 5. Then the beginning balance.
Which
and
is?
then, 1 million,
Beginning
okay.
and then the payment, is it the payment?
payment, yeah. Interest,
Oh, it's interest first.
payment.
Payment.
Isn't the beginning
Payment.
balance then the payment?
Yes.
The payment.
Payment,
Yes.
interest,
Interest and
And
principal.
then the principal and the ending balance, right?
Mm-hmm. Good job.
Great job. Ending balance. Okay, so then how would you start calculating this out? With 298,
Yeah.
315, 55. But we know that's our payment.
Oh, we have to figure out the interest.
Figure out the interest rate.
15%,
Which
right?
is
So we're
the
15%.
the 298 something times 15%, is that it?
No.
The interest,
Should be
to find the
15.
interest, to find how much
Wait,
the
is it
interest
1
is.
million? It's 15%.
Oh, 1
million.
million, okay.
51 million, 15%. That should be. That should be.
no. We'll go forward.
It's the
We're
1
all-
million times the
we're all a little
15%.
brain dead.
Yeah.
1 million times the 15%.
Interest rate,
150,000.
150,000,
Okay.
so 150K.
Oh.
So that would leave our principal at 148, right? About. We have an ending balance because we subtract 148 from 1 million. We'd have 851. What's the change?
And then the ending balance becomes the beginning balance.
Yes.
And in the interest
And then
of
the
time,
process starts all
the
over.
principal should equal
The
to
only
the starting. the
That
beginning.
remains constant on this entire
Is the
table
payment.
is the payment. Payment never changes.
The principal altogether should add up to the beginning balance.
Right. Interest rate is gonna drop as we
Yes,
continue to
as
go
it
through the
goes
years.
up.
Principal amount's gonna increase, and then this should equal the original loan amount. If you kinda wanna do a gut check. And what your ending balance should equal.
Zero.
0. So that's how you know if you get down here, there may be some change left over if there's like a rounding error or something. And if that occurs on your exam, you know, I'm not gonna count you off because you left 0.1, like 10 cents or something. But you know, just do a gut check and make sure you did all your math right, you know, if you transposed all the numbers correctly. I think, I have one more, I think that was it. Yeah. So kind of just like a quick check to see where we were at.
Do you have this on D12?
I don't have that particular slide deck up on D2L, but if you'd like to work through any of the problems in the book, and send me what you got, I'd be happy to look at it for you. Let's see. Okay. So financial condition analysis. This one we may not make it through all the way, but it's fine. We'll get through it together. If we don't, for some reason, get through the entire thing, I'll do like I did last time, and I'll just record the supplemental video to go with it. That'll go over it, and we can talk about anything, any questions you have. You can email me, whatever. We can talk about it after spring break when we get to it. So financial condition analysis, we're going to do a quick review. Now you should have 3 sheets, right? You should have a statement of cash flows, a balance sheet, and an income statement.
No.
Go ahead and grab mine.
No, you took the
So we're going to be doing a quick review over some stuff we talked about last week in terms of these financial sheets. And remember last week we started to introduce some different ratios, and so we have one lecture that's very ratio heavy. Well, we've arrived there. We're ratio heavy now. I may have made extras, so that's fine.
No, I have 2.
See how this is?
You have the same ones?
Yeah.
Oh, there
Yeah,
it
you
goes.
should have a balance sheet, a statement of cash flows.
Okay.
And if you're on a laptop or for my online students, this is posted under Module 4. It's just called Chapter 17 Financial Sheets, I think, for Riverside Memorial. Again, you know, this is just so we don't have to keep flipping around between the slides and kind of have all the information right here. So we're going to go over a couple different types of ratio analysis, talk about KPIs, and then we'll be done with Chapter 17. So quick review. When we talk about financial statements, we said they answer 3 main questions. You may remember what those main questions are. Or what financial sheet answers. Sorry, I guess the questions would be helpful, wouldn't they? So what financial sheet is going to go over where businesses get its cash, what they did with the cash, and how it changed.
The cash flow.
The statement of cash flows, right? So cash flow is going to tell us where we got it, what we did with it, and if we got more or less, or kind of how did our position change over the period. What is our basic accounting equation?
The assets equal liabilities.
Assets equal liabilities plus equity. Just remember A equals L plus E. What financial statement is going to demonstrate entire amount of net income for a nonprofit that's going to flow to the balance sheet and reconcile the income statement net income with the balance sheet equity account? And it's gonna indicate how much net income will be retained in the business.
Changing the equity. I just saw on my slide, I didn't actually know.
She's trying not to look. She's trying not to look. So what financial statement? Right.
I knew that.
So income statement's gonna report operations over some period of time, right? So we look at, a certain defined time period. We're going to have revenues and expenses. We're gonna measure profitability here. And we're gonna have information on our, information on our operations and our profitability on the income statement. So what about liabilities and equity of the organization and assets of the organization? What financial statement's gonna tell us that?
In the balance.
Balance, right? Because we want assets to equal liability plus equity.
I didn't cheat on that one.
I trust you. So a couple notable terms. We haven't particularly covered over these yet, and I still haven't found like a crafty way to work them into the lecture besides just giving them to you and us noting what they are. So you're gonna have a couple different notable terms. One being salvage value. Salvage value is gonna deal with assets, particularly at the end of their life, or useful life. You know, we know a machine is gonna have a useful life of maybe 10 years before it's either outdated or it needs to be replaced, or, you know, we've done so much preventive maintenance on it that it's just time to replace it because it's not worth the payment out that we're paying to repair it. So salvage value is going to be what the market value is at the time of the end of the useful life of that particular asset. Opportunity cost, we just went over this in the last lecture. But again, you know, it's just that return that what is our alternative? You know, if we're taking our money and investing it in XYZ investment, what could we earn in the alternative on something that's similar risk? Terminal value, estimated value of cash flows beyond the ending point or the truncation point. And then sunk cost is just that outlay. You know, just think of it, what have we already sunk into it? You know, we can't get back. We are committed at this point because we've sunk our money into it. Excuse me, I got some cough. So financial condition analysis, we're going to look at a couple of different techniques. We've touched on financial statement analysis through last week's lecture, just focusing on assessing really what our organization's financial condition is at the time. Today we're going to look a little bit more into operator indicator analysis. So these are going to be things like, last time we talked about days cash on hand. We're going to talk about things like days in accounts receivable, how much salary we're paying per occupied bed in our facility, things like that. That's going to explain our financial performance. So, slight difference in the two. One we're assessing, the other one we're kind of explaining what's going on. So I'm just gonna not breezing over these just because they're what you have on your financial statements that you were handed out. And again, this is posted on D2L under the Excel sheet, under the file, the Excel sheet, Chapter 7, Financials for Riverside Memorial. But just wanted you to have them available so when we start working through a couple of these ratios, you'll have that information right there to do the calculations. Now, I was telling Ashley that I recognized a pretty significant error throughout this slide deck. I'm not sure what happened. So I think I have everything fixed. It was regarding the numbers not matching what was on the financial sheets for some reason. So I think I have it fixed. If you notice something that's off from what is presented on the financial sheet, please let me know because it's entirely possible that I've missed something. But I think I've got everything fixed. So as we go through, just kind of help me keep a little vigilant on watching that. So when we look at ratios, we go through and construct these different ratios to tell a story about how our organization operates financially and what type of condition we're in when we compare to our competitors and to the industry standard. So when we put kind of like a financial spin on that, we are taking the information that were presented on our financial statements, which is why we went over them last week, so we can kind of set that groundwork for what we're going to be talking about today. We take the information that's on our financial sheets and kind of transform those into a single number or percentage or ratio that can tell us with, you know, some certain level of ease what economic significance that has, especially in the healthcare marketplace. And to help us compare, you know, to give us a good comparison industry-wise and with our nearest competitors. But before we can kind of start going through and determining or beginning these ratio analysis, there's a couple things we have to do. We have to understand the nature of the business being analyzed. In this particular setting, you know, we're looking at healthcare. We have to understand why we're doing the analysis in the first place. So, you know, we always want to begin with the end in mind. What's our end goal that we're trying to achieve so that we know kind of how to structure these activities that we're going to do. We have to go out and look for comparative data because we can't just say, oh, well, that ratio is 7%. What does 7% mean? 7% good, 7% bad? What does that really mean? So we have to have available comparative data to compare, you know, our end result to, and we have to know benchmark data. So we talked about benchmark data at the very, very beginning of the semester. Somebody remind me what benchmark data is?
Your baseline or your
Starting, some sort of starting. This starts.
Wait, there's a baseline and there's a benchmark. What's the baseline?
is your benchmark like your goal?
Yeah, benchmark's what we want to reach, right?
Okay.
So benchmark is like the industry standards of, you know, where we want to be. Baseline is where we're starting. Benchmark is where we want to be. So we start to look at interpreting these ratios. Like I said, I'm going to show you, we're going to walk through several, and I'm going to show you how to calculate them, but we have to go beyond calculating these different ratios and really interpret what the data is telling us. So if we have a total profit margin of 7.3%, well, that's great, I guess. I don't really, you know, what does that really mean to us? Or, you know, it has very little meaning. So how do we kind of interpret what these numbers are? We look at trends and we look at different comparative analysis out there. So if our nearest competitor has a total profit margin of 9%, is that good? You know, are we doing good or are we doing bad? Or how do we kind of compare? So we can't just take the singular number from our ratio analysis. We have to compare it to our own internal trends over time. So, you know, this time last year, what was our total profit margin, and have we increased our position or decreased our position? And then how do we stand up to our nearest competitors out in the marketplace? So there's a couple that we're going to look at, and here, you know, there's 4 different types of categories that we're going to look at, and they each have several different ratios laid out inside of them. So the first one we're going to talk about is profitability. And the question that we're answering here through profitability is just what you can imagine by the name. Are we generating sufficient profits for our business activities? You know, are we doing things that's going to help us keep the doors open? It kind of gives us a pulse on, you know, we're doing good, stay the course, or we need to make some corrections right now. So the first one we're going to look at is total margin. Now, what do you think total margin ratio is going to tell us? Or profitability margin? Well, it's one of the profitability ratios, but total margin ratio, what do you think total margin is going to tell us?
The difference between the cost.
Yeah, it has to do with cost, but we're looking at it from a profitability standpoint.
So it'd be the revenue.
Yeah, so we're going to look at what's our ability and how do we do in terms of generating different revenue from all of our different sources, whether that's premium revenues, patient revenues, operating income, non-operating income, and how well we do at controlling our expenses. So is our revenue exceeding our expenses, which is what we want, or are we spending more than what we're bringing in? So total margin is going to tell us that. And how we're going to go about calculating that is net income divided by total revenue. So if we look at our financials, our 3 financial sheets we have, what is our total net income going to be? Or what sheet are we going to find that on first?
The income statement?
Well, our total net income. Right. The income statement of operations. Is that what you said?
Okay, that's what she.
Sorry.
I know.
Sorry.
Like,
Sorry.
wrong?
Yeah, so we're gonna find that on our statement of operations or our income statement. And what's that number gonna be, guys?
Net income,
We're looking at net income.
2015.
Yeah, everything's gonna be in 2015.
Mine says 2098.
8572.
8572. Are you looking at non-operating?
Yes. No, I just looked at the wrong line.
No, that's fine. So we're gonna take 8572 and we're gonna divide that by what?
The revenue. Total revenue, which is 112050.
So total revenue, but what else is not included in total revenue that we need to include? It's on down the line through there.
Expenses minus expenses.
Income,
What about the non-operating income?
Uh,
More activities to do with our retail sales, like cafeteria, gift shop, parking tickets, things like that.
so we add that.
Right. So we're gonna get 8572 divided by 114148.
So is the non-operating income, is that the net? The net income?
Net income is going to be our total revenue after expenses. But we still have to add the total revenue and the non-operating income together.
Okay, so it's in both places
Mhm.
basically.
So we're going to get, now that we know that the total margin, which, when you change it over to percentage, it's going to be 7.5%. We said, well, great, 7.5%. What does that really mean? So what do we need to make this ratio, beneficial to us or give us some inside knowledge? What are those different things that we might need?
What you
So-
mentioned previously.
Yeah, so we said there's 2 things, right? We need comparative analysis, we need data trends over time, right? So our total margin, 2015, 7.5, 2014, 2.2, the industry standard is 5.0. So how would we go about interpreting this ratio? And we'll go ahead and go over this one because I asked several questions like this throughout the lecture today. So we'll do this one as free. The hospital is going to make 7.5 cents on each dollar of revenue that we bring in. So we're making 7.5 cents. We know that we're above industry standards because industry standards probably make about 5 cents per dollar of revenue that's being brought in. So going beyond how do we interpret it, what is that going to tell us? So we're looking at how well we control our expenses. And this is a really good indicator that we're doing a great job controlling our expenses, especially after our increase from 2014 to 2015.
Yes.
Right? So we did a really good job at controlling expenses, but it can also tell us that maybe our charges are too high, our costs are too low, our expenses are too low, which I don't know why you would complain about your costs being too low, but so it can indicate a couple other things, and then high non-operating revenue. So we know as part of that total revenue, we took revenue plus our non-operating income. So it could be that we're not bringing in a lot of revenue, but we're supplementing it with what we're bringing in terms of non-operating income. So maybe we're having a great year with our retail sales, our gift shop sales, maybe everybody that pulls into the hospital parking lot is getting a parking ticket for $20. I don't know. So we may be doing a good job with non-operating income or non-operating revenue. Make sense? Kind of how to interpret it and what it's really telling us. So total margin gonna tell us how much revenue we're bringing or how much we're bringing in on each dollar of revenue, and it can indicate a couple things to us. In this case, it's indicating good expense control. So we look at operating margin. So we just looked at total margin. Now we're going to look at operating margin. Main focus of operating margin is going to focus on our core business activities. So we're going to look at operating income divided by operating revenue. So what are our numbers going to look like here? Well, first, somebody tell me the sheet that we're going to go to find this information.
So the income rate.
Right, the statement of income, the income statement or statement of operations. And what's that operating income gonna be?
The operating income.
6474.
6474.
Mhm.
And then we're gonna look at operating revenue. So what is that number gonna be?
So where'd it go? 112,050 plus the 2,000.
Right,
980.
115,371. Or our other revenue, sorry. Yeah, total revenue, operating income. So we should get 5.8% after we calculate that out. So what is this real? Let's see, I have this on the next slide. So how are we really going to go about interpreting this? So we know how to calculate the ratio. Operating margin equals operating income divided by operating revenue. We know that we're at 5.8%, industry standards 3.1, so how do we go about interpreting this? Simply, we're more profitable than the industry standard or the industry average. So the difference in operating margin and total margin is the removal of the non-operating income. Wait, hold on. I think I added something back in. This is where I told you I was trying to hurry up and fix this before class. I think it should be 112050.
So it's not with the non-operating.
What's that?
It doesn't.
It's operating,
Yeah,
so it could
operating,
be non-operating.
Yeah. I'll go back and fix this and post a new slide deck for you guys, okay? I apologize for this. Like I said, I caught it at the very last second with like 15 minutes left before class started, so I was trying to rush through and get it fixed. So we removed the non-operating income. Oop. And we're looking primarily at investment returns here. Let me make shoot me an email. Thank you. So the first two, total margin and operating margin. Now we're going to look at more of our assets. So we're still looking at profitability, right? So now we're going to look at our return on assets. We talked a lot about return on investment. So now we need to look at specifically our return on assets. And it's just going to tell us how productively we are using our assets out in our field or in our facility or wherever we may be. So the greater net income for each dollar invested in assets, we're going to think it's going to equal more productive assets, right? Based on a higher return on assets. So here we're going to take net income divided by total assets. And where are we going to find this information? We're going to go to the balance sheet for which part?
For the total assets.
For the total assets. So what are we sitting at for total assets?
151,278.
Okay, and then where are we going to go for net income?
Back to the income statement.
Income statement. So we're going to take 8572, divide that by 151,278. And that's going to give us a return on assets of 5.7%. Now, what does this mean, or how are we going to interpret it? For each dollar of assets that we're bringing in, each dollar of assets is going to generate almost 6 cents in profit for us. And of course, now we need what the average industry average is. So industry average is 4.8%. So what is that going to tell us, or what is that going to indicate? we have a really good control of our expenses, right? We're able to leverage our assets that we have so that they're able to produce more for us than the industry average. We're able to bring in almost a cent more than the industry average in terms of profit, which sounds small, but then when you think in the hundreds of millions of billions of dollars, that's a lot. So we're really, really good at controlling our expenses in terms of our return on assets. Now again, if this gets confusing or if you guys start getting confused, please let me know, because I'd rather slow down, really go through this and have to record something later than rush through it and you guys still be confused. So we looked at return on assets. Now we're going to look at return on equity. And in terms of nonprofit organizations, this is going to tell us how well community supply capital is going to be used. So here we're looking at net income, which we know is 8572, and we're going to divide that by our total equity. So we're going to go to which sheet? Income statement and balance sheet. So since we know our income, what's our equity?
107,364.
107,364. So we're going to have a return on equity of 8%.
Wait, where's 107?
So equity is going to be on your balance sheet. It's right above your total liabilities
Thank you.
now. See?
Yes.
Yeah. So how are we going to interpret this one? Same as we did the return on assets, right? So we're able to generate 8 cents of income for each dollar that we invest in equity. And the industry average is 8.4. So this is a different kind of dynamic than what we talked about with return on assets. So what do you think this kind of information is indicating to us, knowing that we're sitting at 8% and the industry average is 8.4%? That we're what?
For equity?
Right, so we're talking about return on equity.
Yeah, so we're getting a return on our investments less than the industry standard.
Right, so we use low debt financing, is what this is telling us. So the industry average is they put about 8.4% of each dollar to an investment, and we're putting about 8%. So we use a lower level of debt financing than what the industry average does. I know these all probably start to run together, so like I said, just feel free to stop me at any time. So just to review over profitability, we have total margin is going to look at our ability to generate revenue and control expenses. So you just, what is our total margin for the entire organization? We're going to look at revenue and expenses. When we're looking at operating margin, just think about the operations that are core to the business. So we're honing and focusing in on core operations of the business to keep the doors open. What are we looking at from an operations standpoint? Return on assets, or ROA, we're looking at how productive we're going to be using our assets and how much revenue our assets are generating for us. And then return on equity, how well we're using the more community supply capital from a not-for-profit standpoint. Good? So liquidity is the second one that we're going to talk about. So we're talking about how liquid the organization is and how readily available we are to meet those cash obligations. So we said liquidity, on the just forgot the word I'm trying to use, but we list our assets in terms of liquidity, right? So we have cash first. It's the most liquid. We can turn it over pretty fast. So in liquidity ratios, we're looking at how quickly we can meet any cash obligations in case loans are called up, how quickly we can pay those out or things of that nature. So the first liquidity ratio we're going to talk about is current ratio. And here we're measuring the number of dollars. So we're looking back towards assets. How much dollars of assets are available to pay each dollar of liabilities that we have? So if for some reason we have to pay on all of our liabilities at this one moment in time, do we have enough assets in terms of dollars to cover each of our liabilities that we have out there? So here, for the current ratio, we're gonna look at current assets divided by current liabilities. So direct me to what sheet we're gonna be looking at here. Balance sheet. So what is our current asset number gonna be? 31280. And current liabilities, 13,332. So our current ratio is 2.3 times. So the other ones we were in percentage. These were in times. So how would you kind of interpret this ratio before we move on just a little? What do you think? If we know that this is telling us the number of the dollars of current assets available to pay each dollar of liabilities, and we know that the ratio is 2.3 times, how would you kind of go about interpreting that?
2.3 times the amount of our liabilities available.
Right, so we can, so you guys are along the right line, so we're looking at Riverside, our clinic, our financial sheets that we have here. For every liability that we have $2.30 to cover that $1 in liability. So we can it's almost double what our liabilities are, right? So if our liabilities get called up, we have $2.30 of cash for each dollar of liability that may be called up, which puts us in a good financial position, right?
Mm-hmm.
If we get called up, we're going to be able to cover our liabilities. So liquidity, what do you think? Is it more related to assets and liabilities or to cash flow?
I don't know.
What's that?
I would say assets and liabilities, but I don't think that's right.
That's what I was going to say.
Yeah.
So why are you backing away from
No,
that?
I'm still gonna, that's what I was
That's
gonna
what
say.
you're
I'm still
gonna
gonna hold my.
I'm
You're
pulling my
confident.
crown. Okay, so if you think so why do you think assets and liabilities?
I mean, liquidity is basically anything that's cash and can be changed
Mm-hmm.
to cash, and then, I don't know, in the assets and stuff, it's usually, your assets is usually something that's kind of ready,
Okay.
if you will. You know, the liability. Like I'm thinking about it, but I can't really explain it, and then like the liabilities or whatever, it's kind of like the debt part of it, so kind of like you have something and then you'd still need the liquidity of the cash or whatever to be able to pay for it, if that makes any sense.
No, I
I'm
understand.
rambling, but
You,
you know,
you have that problem. I come into
Yeah.
contact, like it makes sense up
Y- y-
here, and I
yeah.
just can't figure out how to get it out here.
like I'm thinking about it for him.
So the business's liquidity is going to be more closely related to the cash flow. Because again, you know, we're looking at the ins and outs. Where did the cash come from? What did we do with it? How did we change our position?
No.
So the next liquidity ratio that we're going to look at, you'll see it abbreviated as DCOH, but this is days cash on hand. And we touched on this last week when we talked about the financial sheets, and I told you, we were going to be talking about it this week. I forgot to change that. Yep. I'll update this one too. I'm sorry, your pencil. Sorry, I apologize, guys. I'm usually more on top of it than this. Okay, so days cash on hand, we're looking at cash plus our short-term investments, and we're going to divide that by our cash expenses divided by 365. Because we're looking at how many days, so we're going to look in terms of a year, 365 days in a year. So days cash on hand, if for some reason we stop generating revenue in, how many days can we survive with the cash position that we're in right now as an organization is what, along the lines of what this should say, not this right here. So I'll update it when I get back down to the office. So where are we going to go to find this information? Cash plus short-term investments divided by cash expenses.
Cash flow.
Cash flows. So what's our first number going to be?
Cash flow short-term investments would be
So what
did I think you go to
What do you think?
the
Yeah, do you go to cash flows or do you go to balance sheet?
balance
Oh.
sheet? The balance sheet.
No wonder I can't find it.
And then the short-term investment would be 4,000.
4,000.
Yeah, and then the cash and is the cash and equivalents would be the 260.
260.
Then we add both of those up top there.
Yeah, so we're gonna take, cash expenses is gonna be your expenses minus your depreciation. So it's gonna look something similar to this, 2263 plus 4,000 are cash plus our short-term investments, divided by whatever our expenses are. So what were our expenses? 105,576 off the income statement, right? Minus our, what level of depreciation we have figured in there already. So we wanna take the depreciation out. Of 4130. We're gonna take that number divided by 365, and then take this entire number and divide it by, divide it by what we get up here. And we should get 22 and a half days. If anybody's doing the calculation, did you come up with 22 and a half days? Sorry. Got a little trigger happy. So does everybody see where these numbers come from? 2263 plus 4,000 divided by 105,576 minus 4130. This is your expenses minus your depreciation, which is going to give you your cash expenses divided by 365. So we should get to 22 and a half days. So what is this telling us? And this is the same information that was just on the previous slide. So how would we go about interpreting this ratio?
That's right.
So if everything else ceases, we can continue to operate as normal and cover our expenses as normal based on our cash position right now for 22 and a half days. But if the industry average is 30.6, what's this going to indicate to us? Or what's this going to tell us? Kind of how can we start to interpret this compared to the industry standard? Are we in a better position or a worse position?
Worse position.
Right, so we're worse than the industry average, and the but it's kind of two-sided. So we need to. You can't just go based off of one kind of piece of information. So the average hospital, when we're looking at the industry average, they may have a greater amount of cash equivalents and short-term investments in their mix than we do. So we have to figure out how to change our cash position, our days cash on hand, to kind of bring this up. Do we need to bring our expenses down? Do we need to increase our short-term investments? What do we need to change to kind of bring us from 22 and a half days, which initially sounds really good until we look at the industry average of 30 and kind of how do we get ourselves to at least that benchmark of the industry average of 30 days. Still good? It's a lot of math, I know. Current ratios, and what I meant to say too, in terms of the exam, I know a lot of ratios are presented in the book. I'm primarily going to focus in on the ones I'm going over here. There may be one or two that I'm putting on the exams to spot check you to see if you've been keeping up the reading and stuff. But I want to focus in on these because these are the ones that you're going to come into contact with most out in the industry. So you should at least be familiar with, the language and what they're telling you and kind of how to interpret what they're telling you. So current ratio, just to kind of sum it up, is going to give us the liquidity of current assets at book value. So how quickly can we convert those over? Days cash on hand, how many days can we cover our expenses? If we cease generating revenue, how long can we continue to cover expenses based on what our cash position is now? And those are only two liquidity ratios that I'm going to go over. Any questions about those? Profitability or liquidity so far?
class about to end?
at 3:50.
Oh, my
Yeah.
bad. No,
You're
we're
fine.
after you. No big deal.
Okay, that's kind of random. So debt management, let's get a good little breakup for us. Debt management will be the next one out of the 4 that we look at. So are we using the right mix of debt versus equity, and how are we kind of managing our existing debt out there? So debt ratios, or the debt ratio in terms of debt management, you're also going to hear this referred to as the debt capitalization ratio. And this is the total amount of capital that's provided by our creditors, which remind me who our creditors are. People who give us our loans, right? People give us the credit, our vendors, maybe if we're buying supplies. So for debt ratio, we're gonna look at total debt divided by total assets. So what are we looking at here in terms of the numbers? What sheets do we go to, and what are our numbers gonna look like? So we're looking at total debt.
Balance sheet.
So like what credit card company?
What's our total debt?
Mm-hmm. Where does it say total debt? Maybe it's under balance sheet.
Is it the
Is it
long-term
all
debt?
of the,
What do you guess?
Is it
all of the,
the liability?
the account payables and the.
Liability.
So 43914, total debt. So we're taking the total amount. So we have our total current liabilities and then our long-term debt. So total debt divided by total assets. So here our total assets are 151,278.
Wait, the total debt is the total current liabilities and what else?
So we have total liabilities
Long-term
and net
debt.
assets
And long-term
at
debt.
151,278. But we need to take out that equity component
Okay.
of 107, right? Because we're just looking at total debt. Like I said, I went through and tried to fix this rather quickly, so if the numbers aren't matching up, let me know. I'll make an adjustment when I get downstairs. So if we divide this out, as it stands right now, we're gonna get a debt ratio of 29%. And so how we're gonna interpret this is our creditors, those people who are giving us lines of credit, on supplies or loans or things like that, they're gonna supply less than a third of our business's total financing. So in turn, or what this is saying is each dollar of assets that we have, when we look in terms of dollar of assets versus debt, we're financing that asset with 29 cents of debt. Which I think we might have covered this last week too. Yeah. So we're financing each dollar of assets that we have, we're financing that with 29 cents of debt. So we're going to 29 cents to finance our asset.
Double check it, we'll check it, I think,
What's that?
because I got something.
Okay.
The total.
The total debt you get 4.2 something.
Yeah, but.
Okay.
42.
Like I said, guys, I really apologize. I didn't notice this till the last second, so I'll go in and make an adjustment and note it on the news feed. When I have those up, and I'll work on that as soon as we get done. So when we talk about debt, in terms of our creditors, why would we be looked upon favorably from our creditors if we have low debt ratios?
Because people trust us with money and we pay back.
Yeah, that's exactly right. So, in a roundabout way, we have the lower the ratio, the greater cushion against our losses. In the event that we go bankrupt or we have to liquidate, they're not going to lose as much as if we have a higher debt ratio. Same reason, when you go to buy a house, they look at your debt to income ratio, I think is what it's called. And so your interest rate is going to be based off of what your debt to income ratio is. Same thing here. If you have a lower debt ratio, you're going to be looked upon more favorably than if you have a higher one, because you're decreasing the creditor's losses in case you go bankrupt or you have to liquidate. Times earned interest, or times interest earned. The TIE is going to be called the coverage ratio, is what you may hear it called sometimes. But we're looking here at the number of dollars accounting income that's available to pay each dollar of interest expense that we have. So here we're honing just on solely the interest expense in terms of our ability to pay off that expense. So we're going to be looking at something called the EBIT, or sometimes it's called the EBITDA. I don't know if anybody's heard it. Does anyone want to take a stab at what that means? The EBIT? No, not even gonna try. It's your earnings before interest and taxes. EBITDA is EBITDA. I think that's interest before earnings, taxes, depreciation, and amortization. But in terms of the TIE ratio, we're going to look at the EBIT, earnings before interest and tax, divided by interest expense. So here, where we're going to go to get this information, the EBIT is going to comprise of your net income plus your interest, because we're looking at earnings before interest and taxes, right? We're a nonprofit, we don't pay out taxes because we're 501c3. So we're going to take our net income plus our interest. We should get 10,114. Look for my sheet, hold on. Add our interest expense back in, 1542, right?
Why do you add your interest if it's earnings before interest and tax?
Because interest is showing as an expense line item on your statement of operations. And so if we're looking at earnings before interest and taxes, we want to take our net income and add that interest component back in. Okay. So we should get 10,114. Then we're going to divide that out by our interest expense, 1,542. So we should get a TIE ratio of 6.6,
Alright,
or 6.6 times.
what and what do we add to get the 10,000?
The net income plus the interest.
Oh, okay, and then take it back from there.
Yeah, and then divide it back off to get 6.6 times. So what the TIE ratio is going to tell us is that based on our current financial position, our interest, we're taking $6.60 of income to pay for each dollar of expense that we have, or our interest is going to be covered 6.6 times. If the industry average is 4.0, this is going to, obviously we're going to see that we have a relatively high margin, and we could expand out our debt financing because we're in such a good position at 6.6 times versus the industry average of 4. So we have room to kind of, we could expand by maybe taking on a little more debt if that means offering newer equipment or a newer service line or opening up a newer, whatever department or whatever the case may be. So we could expand a little our operations by taking on just a little bit more debt financing, not too much since the industry average is at 4 and we're at 6, but we have some room for flexibility there in terms of debt financing. So just to review, debt ratio, also called a capitalization ratio. And we're looking at the percentage of capital provided by our creditors. So in this example, we said less than a third is being provided by our creditors, which puts us in a good cash position, or puts us in a favorable position in terms of our creditors. And then TIE ratio, also called our coverage ratio, is going to look at the extent to which income can decline before it's less than our interest cost. So how much we can expand that debt financing. Still good?
Mm-hmm.
Okay. It doesn't help that it's like really nasty and raining outside either, so. Hope you brought an umbrella today. Asset management. So the last ratio analysis we're going to look at, in terms of asset management, we're looking, does the business have the right amount of assets for its patient volume? So based on the volume that we're bringing into the facility, do we have enough assets to cover the volume that we're seeing that kind of flows in and out of our facility at any point in time? So fixed asset turnover, notice I don't abbreviate it all the way because I don't want to call it a fact, right? So fixed asset turnover, it's, like I said, it's gonna look at the utilization of our property and equipment. So we're gonna look at total revenue.
Have to calculate everything.
Do what?
You have to calculate everything.
Do I have to?
I mean, in the company, you have to calculate always. Is that what they do?
Yeah. they look at a lot of ratios like this. You know, thankfully, that's why we have a financial services department that kind of does this and meets with, you know, each department has a financial analyst associated with them, and they meet with the manager and they talk about what these ratios mean and what this means for your department or what this means for your hospital overall. So luckily, you know, we have a department that does that and kind of can educate us a little bit more. My main goal here is just to make you familiar with all this and the terminology so that when you do hear it, you can kind of think back, oh yeah, we did talk about that. Luckily, I kept my book and I can use this as a great reference to kind of go back and see what exactly that detailed. So we're going to look at total revenue. Again, go 114,148. We're going to divide that by our net fixed assets. So when we look at net fixed assets, we're going to come to 119,998. Now, if you're looking to see where I got that number, that's your net property and equipment. Those are things that are fixed. They don't change, so that's our net fixed assets. 119,998. We're gonna come to 9.95 times. So how do we go through and interpret this similar to other ratios we've looked at already today? Each dollar of fixed assets. So if you're starting to notice, we're looking in terms of whatever's here in the denominator as each dollar of fixed assets or each dollar of revenue or each dollar of debt. Each dollar of fixed assets is going to generate us 95 cents of total revenue. So for each dollar assets that we have, that asset is bringing us 95 cents of revenue. So if the industry average is 2.2, we can kind of see, well, hey, that sounds really good, 95 cents, we're doing okay, we're only 5 cents away. Until we look at the industry average, then we realize that we're not really using our fixed assets in terms of property and equipment as productively as what we may see across the nation in terms of the industry average or even to our closest competitor. So we want to see, you know, how well they're using their assets in terms of generating revenue. So this is going to kind of cue us into, we need to start doing something with our assets to make them more productive and more valuable for us as an organization. So total asset turnover, different than fixed asset turnover. So here we're looking at things that merely are fixed, like our property and equipment. Total asset turnover looks at all of our business assets. So not just our property and equipment, but every asset and how we utilize it across the organization. So here we're taking total revenue divided by total assets instead of just our net property and equipment or our fixed assets. So here, we're going to have 114,148, but this time we're going to go down to total assets on our balance sheet and take 151,278, which is going to give us 0.75 times. And again, same way we interpret this, each dollar of assets, whatever's on our denominator, we're generally looking at in terms of each dollar of whatever's in the denominator, generates 75 cents in revenue. Does everybody see that? If the industry average is 97, we are saying essentially here that our current assets, when we compare them to what we just calculated with our fixed assets, we're using our current assets better than our fixed assets. I thought I had one more there. So in terms of assets, we are much better at utilizing what our current assets are than utilizing what our fixed assets are in terms of property and equipment. So we do much better compared to the industry average. So let's see. I'm gonna go ahead and stop here actually. Cause I don't think I can get through this next part, and we're already about 3 minutes away from time. So let me make a note to start with accounts receivable. And I'll get that video recorded and posted. But guys, do you have any? Do you guys have any questions so far? And then, like I said, when we come back from spring break, we can address any questions you have off the video. Or you're always welcome to email me. I'll be out of the office Thursday and Friday and through spring break, but I'll be checking my email. So feel free to, if I'm not in my office, to email me, and I'll do my best to get back to you in a timely manner. But what kind of questions do you guys have? I know it was a lot of math today. It was a lot of calculations and ratios, and we just need time for it to sink in and get in there. I'll make the adjustments on the slide deck, the ones that I missed in my haste to try and get it put together so you guys would have it.
I guess my question would be where you have like times, like for instance in the turnover ratios, where you put times at the end, if you put cents instead of times. Like if I don't remember and I put 95 cents.
Oh, I'm not gonna count off for minor things like this because I do present it 9.95 times and then 95 cents. As long as you can tell me, we're looking at, as long as you give me the right, close to the right interpretation, yeah. Because essentially we're saying the same thing, right?
I mean, sometimes you do the math and then you don't put that little part on it.
And they get you. Anything else?
Record the rest.
I will record the rest. It'll pick up with accounts, what did I say? Days in patient accounts receivable. We'll start there, and I will update the slide deck. I'll go back to the office right now and get that updated for you guys, and I'll have that new one posted by this evening.
Okay.
But if you think of anything else, like I said, I know it was a lot today, so give it time to digest. Read through the book and see if it helps supplement anything that we talked about in class today. If you guys have any questions, I have an open door policy, so you're welcome to stop in anytime. And with that, if you're going somewhere on spring break, have a very restful spring break. Hopefully you get to, I'm flying out to Arizona with my daughter, and I'm terrified of flying. And so
Your husband's a flight nurse.
I know. I'm terrified of flying, so my goal is to just keep myself composed while I'm flying with my 4-year-old, because she's going to be all excited and think it's the most awesome thing, and I'm going to be sitting there like white knuckle on the seat. And especially since yesterday I found out our flight from Tri-Cities to Charlotte is on a prop plane, a propeller plane, instead of like a normal plane. I know I'm going to end up on the wing, and it's just going to make it even worse.
It's going to be interesting.
There's not a lot of y'all.
I've never flown to or from Tri-City
It's a
Airport.
taxi.
Yeah.
Taxi.
Taxi. Yeah. So you guys have a good, restful spring break. We'll start back. I think we're back March 14th.
Yeah.
So we'll see you guys back then. In the meantime, if you have any questions, please let me know.